This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, the Mackenzie Investments podcast. I'm your host, Dustin Reed, Chief Fixed Income Strategist at Mackenzie in Toronto. Speaking to you about an hour after the press conference for the most recent FOMC meeting finished, the June 2026 FOMC meeting, which obviously had Chairman Warsh's first attempt at obviously leading the Fed, as well as the FOMC and initiating the press conference. This was a seminal meeting and press conference that had a lot of content and changes, as well as the promise of upcoming changes going forward. So we'll talk about all of that and what I think it means for markets going forward and how markets have taken that initially. First thing I would note, of course, is that the Fed did not change rates as was broadly expected. Fed funds in the US continues to be 3.5 to 3.75%, where it's been for the balance of 2026. The market a week ago was probably leaning a little bit dovish coming in, still leaning on kind of the idea of Mr. Warsh coming from the US administration, being Trump's obviously pick for Fed chair, and the idea that Trump wants rates to be broadly lower. But I noticed last week, as we kind of made the turn from Friday, some of the Friday pieces and into the weekend, and then Monday, a couple of days ago, that some market sentiment had switched a decent amount, and it kind of flipped a little bit from being maybe a little bit net dovish to a little bit net hawkish, and the market maybe being a little bit more concerned around upside risk to inflation, particularly given some of the inflation data that we had last week on the US side with CPI and PPI, with PPI coming in particularly strong. What we got today from the Fed was exceedingly more hawkish than where I think market consensus was, and even more so than where I was. And I was looking for a relatively hawkish outcome. What we got today was, with the dot plot, 9 of 18 participants looking for a hike or more before year end. Of the 9, 6 were looking for 2 hikes or more. There was one person looking for 3 hikes before year end. That's a pretty significant flip from where we were 3 months ago. Chair Warsh did not submit forecast dots. So he spoke from a very neutral position, not necessarily speaking with his own forecast, but was really trying to, I think, frame the discussion of the committee and the median of the committee. And because we had such a big move in terms of expectations for rate hikes in 2026 for the second half of the year, you saw that language come through in the press conference. Maybe before the press conference, I would note that the formal statement, was one of the big changes that was made today. The statement was probably about 2/3 shorter than where previous statements had been, including the most recent FOMC meeting, which was the last meeting under Chair Powell in April. I would say, without having done a word count, it was probably about 2/3 shorter. Very factual, just a handful of paragraphs, really just stating the facts. And I think that is going to be a good bellwether of what is to come in terms of how Chair Warsh wants to communicate publicly going forward. Arguably less communication. Even the press conference was maybe 15 minutes less than what Chair Powell has been doing. The official statement was less. There's talk of the SEP, the Statement of Economic Projections, either getting changed or being quite a bit less. And there's talk of less speeches throughout the system, both from district Fed presidents as well as governors sitting in Washington, D.C. So you kind of got a bit of a preview of things to come. I think here that this Fed is very clearly concerned about inflation. When you look at some of the other things in the Statement of Economic Projections, not just the dot plot, but some of the regular forecasts, particularly around inflation, and I would say core PCE inflation, which is still the Fed's benchmark, it was significantly higher than even, I would say, many of the bullish or hawkish forecasts on the street. And even in 2027, the Fed at this point does not have core PCE coming back down to target. That suggests to me that the Fed is going to be on some sort of hiking path here quite soon. I think the question is, there are obvious questions, but when and how much? Going into the meeting, I was saying to most advisors and to the investment team that I thought the September meeting, we just had the June meeting, there's a July meeting, and then the September meeting, I thought the September meeting was live, i.e., that there was a pretty good chance that the Fed would be hiking at the September meeting and that it was underpriced. Coming out of this meeting now, the June meeting, I think that's even more the case. And I think that July is actually maybe even somewhat live for a hike as well. The last I looked, we had moved from around 3 basis points price to about 9 or 10 basis points. So about 40% probability of a hike in July, with September sequentially almost fully priced at around 22 basis points, so above 85%. This will bounce around, of course, but I think the point here is that this Fed is quite concerned about inflation. This is the old Kevin Warsh that we knew, for those of us that have been around since the late 2000s, that he is a hawk at heart. He's an inflation hawk at heart. And he is, I would give him credit, he is messaging the median view of the committee, which has clearly turned, and we can tell from the speeches over the last 3-4 weeks, the median of the committee has clearly turned from slightly dovish to neutral, and I would argue slightly hawkish here. This seems to suggest that the market needs to catch up a fair bit on cross-asset pricing. On the fixed income side, we're seeing a significant flattener in fixed income. So what that means is the 2-year notes, yields in 2-year notes are significantly higher. Last I looked, they were about 16 basis points higher, and the 30-year rate was actually almost unchanged, if not a little bit lower, maybe 2 basis points lower. So you're seeing maybe an 18 or a 20 basis point flattening in 2s, 30s. And that's a very significant move. It's probably a second standard deviation move. Not surprisingly, with that repricing in the term structure of interest rates, you're also seeing equities sell off and the dollar, US dollar, significantly higher against almost all currencies globally. That would be kind of the textbook reaction that I would expect for A, this type of announcement, and B, the surprise around this type of announcement compared to where I think consensus, although not necessarily us, but a consensus of where the market was. We are going to see a fair bit of change, as I alluded to a minute ago, from the FOMC in the months ahead. And during the press conference, Chair Warsh talked about 5 task forces, his term, as opposed to committees, 5 task forces that are going to be looking at various things around the Federal Reserve System and reporting back to him and the committee. Those 5 things, for those that have not yet seen, are: 1, Fed communications; 2nd, the Fed balance sheet; 3rd, the use and reliance on existing data sources; 4th, productivity and jobs in the era of transformation, obviously with an AI as part of that transformation; and last is the Fed's inflation framework. Some discussion as to what the inflation framework will be going forward. Of course, we know coming in that Chair Warsh, before he was chair, was speaking about changing the core PCE estimate for the Fed and making it a trimmed mean PCE, which is, depending on which one you look at, but the one he was looking at, the Dallas Fed, a trimmed mean PCE running around 2.3 or 2.4%, which obviously is a lot closer than 3.3% to the 2.0% target. We will see what the task forces come back with on that. But the initial first blush here, I would say, is that Chair Warsh is shying away from that new idea around trim mean PCE and is taking the inflation outlook very, very seriously. I counted at least 4, if not 5, if not more times during the press conference that Chair Warsh said exactly that the committee is taking its focus around price stability extremely seriously. And that was one of the things that was in the shortened formal statement. And I believe from memory that it was the last thing said in the formal statement, which obviously is not insignificant. We've been talking a little bit over the last couple of weeks from a market's perspective about increased volatility in the coming weeks and months. And I think today's discussion and decision by the Fed probably underscores that. With term structure of rates moving higher and maybe significantly higher, I suspect that there will be increased volatility across asset classes or higher cross-asset vol. You can see it already in equities, although it's very early days. And you can definitely see it in foreign exchange and FX. Of course, very, very early days. Credit volatility, increased credit volatility would also not surprise. And of course, rates volatility seems to very much be there. Obviously, equities and high beta assets have had a very good run over the last number of months, with many indices, particularly in the US, hitting all-time highs. Part of that, not all of that, but part of that, I think, has been this idea that the Fed probably won't hike rates. And if it does, it's going to be relatively slow in doing so, which isn't necessarily great from an inflation perspective, but it is quite good from an earnings and from an equities or high beta perspective. Today's discussion and outcome from the Fed has the potential to change that. Earnings still remain very, very strong, and that is the story that will continue to power high beta assets and in particular equities. But if the curve continues to reprice higher, and if the back end of the curve continues to reprice higher, which I don't particularly expect, but if the belly of the curve, 5-year and 10-year notes continue to price higher from a yield perspective, and credit becomes more expensive to obtain by consumers and by businesses, small and medium-sized businesses, as well as large businesses, that will constrain the economy and that will constrain the consumer, even with oil having come off and gasoline prices or prices at the pump having come lower. And that has the potential to disrupt, I would say, kind of the almost one-way linear move higher in equities and the carry trade that has obviously also powered a fair bit of emerging market trades, particularly within the rates and currency space. Credit, particularly, I would say higher yielding credit, might also be a bit at risk if we do see a significant move higher, continued follow through higher in the term structure of interest rates. So the early days now, but the takeaways here, I think, for investors are one, Warsh is very serious about inflation, kind of bringing in the old Warsh, as it were. And the Fed will very likely hike rates, I think, at least once, if not twice, before the year is out. Secondly, volatility across asset classes is likely to be with us here as expected over the coming weeks, and I would say months over the summer. And then third, I would say that the communication strategy coming from the Fed is going to absolutely change. In fact, it has in a way already, but there will be larger changes to come going forward. And so I think that we'll look for those. And obviously, everybody will need to adjust in terms of how to watch the Fed going forward. I'm not saying it's going to be more complex, but it certainly just might be a slightly different adaptation of the way that we've looked at the Fed, I would say, in the past. With that, we'll wrap it up for our discussion of the June 2026 FOMC meeting and market outlook. Thank you very much for listening to Mackenzie Investments Market Exchange podcast, and we look forward to seeing you on the next episode. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.